Hello, traders. It's Sunday evening, March 12th. We've got a busy week ahead. We got the CPI on Tuesday. We do have the Fed making some comments tomorrow. They're in normally their blackout period, but they have to respond to the SVB bank failure from last week. They have to calm the market down. Right now, the S&P futures are up over 50 points, and they have stated that they are going to allow depositors to withdraw funds up to $250,000 on Monday. So they are trying to calm the market. Could there be more issues to come? Yes, there certainly could be. When you have 0% interest rates, you have the economy wrought with excess. It's frothy. There are going to be a lot of company failures and bank failures as the cost of capital increases. So this is just the first sign of trouble. Where there's smoke, there's fire oftentimes. Yes, perhaps conditions are different now than they were in 2008, 2009. That's certainly what the Fed and the Treasury are going to be convincing us all of. But I will also tell you that credit is at all-time highs, and you can go from one end of the spectrum, from the little consumer all the way up to sovereigns. And I'm talking about the US, I'm talking about the European Union, I'm talking about provinces in China, I'm talking about Japan, municipalities, states, record debt levels. So there's plenty of leverage to the degree that the central banks can ease fear. They can continue this Ponzi scheme where they continue to print money, and it can go on for a lot longer than you would ever think. So I'm not going to be the guy here tonight telling you that the sky is falling and we're going to head into a global financial crisis. But I will tell you also that there are plenty of cracks in the dam. So don't know when it might happen, don't know if this is the time when it could possibly happen, but what I do know is that there is a discovery process that banks go through right now and trading institutions go through. And what happens is when they see the first crack in the dam, they are on high alert and they start monitoring other activity. Remember, these banks, they are involved in order flow. So they are processing trades and orders for large asset managers, for other banks. And so they see what's happening. They also can see and they're aware of what other holdings other institutions have. And so when they start to see liquidation, they can get a sense for who's in trouble and who's not. We don't have access to that information, but we all have access to real-time charts. So all we have to do is watch the price action. Right now, we've got the market was pulling back. You see this just kind of mixed overlapping candles, choppy range. Everything was looking pretty good. I was finally starting to dip my toe in the water and take some longer term swing trades, selling naked puts to acquire stock. I'm going to take assignment on those stocks. I like them all, so I don't have any concerns about that. I was also selling some out of the money call credit spreads, some out of the money bullish put spreads. The point is that right now you should hold off on your swing trading. Barely got started because we had choppy, compressed trading ranges, really no market momentum. We had this nice support level that was forming. The market had been above it for quite a while, which strengthened that support level. We had this little bounce last week, and then all of a sudden, this big smackdown. When we are going to challenge a support level, this is how we want to attack it, with these long red candles on heavy volume. This is a problem. This tells us that there is heavy selling pressure. Now, tomorrow, the market's going to open right around that 393 level on the SPY. Let's see what happens. I wouldn't read the headlines. I wouldn't take a lot of comfort in what you read because everyone's going to tell you this time is different. That's what they always say. I recall back in 2008 when Countrywide Financial was going under. This is in about July of 2008. Everybody was saying, well, it's just one, financial institution. It's not that big. When things start to head south, they head south very, very quickly. So, right now, let's get back into day trading mode. Look at these intraday ranges. They are fantastic. There's no reason for us to take a lot of swing exposure until we have maybe another 3, 4, 5, 6 weeks worth of data. And if we start seeing that the market really is stabilizing and the second shoe doesn't drop, then we can take comfort starting to look at maybe some longer term swing trades again. If we see that the market can't get back above this was support, now resistance level, and that we start leaking oil and drifting lower and lower and lower, it means that there could be some trouble and that we need to err on the side of caution and that we need to focus on the short side. That's it. That's all I've got for you. I will say that any interest rate sensitive stocks are going to be decent plays, especially when it comes to consumers trying to access credit. It could be for new home purchases. It could be heavy equipment manufacturers like Caterpillar. Took a nice big drop last Friday. You can see how it cracked through this major support level. It also broke through this 100-day moving average. There's also a longer term low minus trend line that it's testing. Yes, if the market reverses, comes up and it tests that support level, resistance now was support, and it starts to back off, then I think we've got a nice opportunity to short this stock if it breaks below that trend line on a day trading basis. If the market rallies up and stays above those major moving averages for a few weeks, okay, we could start to take some comfort. The Fed, if they're smart, they're going to take their foot off the brake just for a little while, even if inflation remains high. Now, we did get some good news in the jobs report. Hourly wages came in at 0.2%. Wages are the largest input cost for manufacturers. It is inflationary, but that 0.2% increase was a low number. So that bodes well for inflation. So we'll get a look at that on Tuesday. As far as any kind of trades for trading tomorrow, here's what I would do. Back into day trading mode. We're going to hold off on our swing trades. We're going to watch what happens at this 393 level. If the market hits that level and then we start to sink lower and sink lower and sink lower, and if Caterpillar breaks below the low from Friday, I think this is going to be a really nice day trading short. We did have in the last video a bullish put spread that I was looking to put on, and it was OKTA. And that spread was not in range until Friday. You can see, look how well that stock has held up. So yes, you can sell that bullish put spread and get the credit we were looking for. It was the 75-70 bullish put spread below this 200-day moving average. When you see the market cratering like this and taking out major moving averages, no, you should not be thinking Friday, hey, I can get that credit for this. This is a major support level. Market first. So until I see the market stabilize for a while, I'm not going to be selling that out of the money bullish put spread on OKTA. I'm going to go back into day trading mode. This is a big deal. This is the second largest bank failure since the financial crisis almost 15 years ago. So yes, we need to monitor and see what else is happening out there. So take a deep breath. Let's see what the Fed comes out with this week. Let's see how the CPI comes out. If the market starts to stabilize here around those major moving averages at 393, and if we kind of get back into business as usual in the next 3 or 4 weeks or so, then we can start to take comfort knowing that banks have done their due diligence. Institutions, trading firms are monitoring order flow. They're not seeing any other signs of trouble. Watch other large banks to see if there are any of them that are selling off huge. If you see that, it means that they may have a lot of risk exposure and that they may need to shore up their balance sheets as well. So that's what I'll be watching for. Let's see how the week unfolds. Good luck with your trading.
Thank you for watching this YouTube video. I'm Pete Stolzers and I'm going to keep the trade ideas coming along with lots of education, so make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.